Assalamu alaikum. How are you, friends? So today's video is on financial objective. This is a short video, right? We are going to discuss three types of financial objectives which are very important for financial management, but there are more than three. But the main three we are going to discuss in this video, and then at the end of this video we are going to we have to distinguish between satisficing and maximizing returns or profits. What does it mean? So starting with financial objectives. Being a studying financial management, you have to know what are the financial objectives, right? There are three types of financial objectives we are going to touch on this video, but there are more than three types. First, the very important one, the fundamental principle which your financial management is based on, that objective, that principle, that is shareholder wealth maximization. Shareholder wealth maximization is a fundamental principle of financial management. How can you increase shareholder wealth maximization? You can increase the share price or dividend payout. Next, we have profit maximization. Now you have to be very careful that profit maximization is not same as maximizing shareholder wealth, because most of you will be questioning why it's two different things. It's two different things, right? The next slide will discuss more on that, the criticisms of profit maximization. So the third is EPS growth, earnings per share growth. Very important. So shareholder wealth maximization, profit maximization, and earnings per share growth. These are the three important things you're going to discover throughout the course. But mostly it is shareholder wealth maximization, the fundamental principle. Market share and then social responsibilities. Right? We're not going to touch upon market share and social responsibilities. There are more than this. It's not limited. Next, we have the criticisms of profit maximization. There are three main criticisms of profit maximization. That means why someone should not hold profit maximization as an objective, because there could be three problems. Number one is long-term versus short-term issues. What happens, right? In companies, you have seen that it's easier that you cut on your short-term expenses so that you can make profit. But what happens, you are making profit in the short term, but in the long term is affecting. For example, discretionary spending. Like you're reducing your spending on training, you're not training your staff, you're not advertising, you're reducing the cost, you're not investing in research and development in the short term. What happens? Yes, it's true that in the short term your profit will be good. You're showing a good amount of profit. But in the long term, this will have an impact. How? Because if you're not training your staff, they will be redundant. They will not be competent tomorrow to compete. They'll be thrown out. Staff turnover will increase. Right? Research and development. If you're not innovating, competitor will come and take over you. So in the short term, yes, you are having a profit, but in the long term, your competitive position will be not good. So this will have a long-term impact. That's why profit maximization is not a good objective. Right? And as a result of this, even your share prices will fall. Right? Stock exchange will see this. Because share prices will take time to fall. It does not fall in, drastically it will not fall in day one. Slowly, if you're having this, that you're cutting expenses short term, in the long term, when it's having an impact, even the share prices will fall. So ultimately, you're not maximizing the shareholder wealth. So your fundamental principle, which was shareholder wealth maximization, is also not achieving that. Next, risk of earnings. You are taking huge amount of risk to cut that, to show increase in profit. You're taking risk. What happens because of the risk? If you're increasing the profit and risk is also high, then it is considered that those earnings are of a poor quality. Okay, and people and shareholders who are risk averse means they don't want to take risk, right? What will they do? They will share their sales. They will share. Sorry, I'm sorry. They will sell their shares. Why they will sell their shares? Because it's of high risk they are having. So they don't want to take a risk because they are risk averse shareholders, right? One is risk seeking, risk taking. One is risk averse. There are two types of shareholders. Shareholders who does not want to take so much of risk, they will sell their shares, and definitely when they sell their share price will fall. So not a good idea. Third, cash. Cash. Why? See, accounting profits are just a paper figure. But what's most important is cash, not profit. Because profit, you can manipulate profit. It's just on papers you are showing the profit. But actually what matters is how much of cash you are having at the end of the day. Because dividends, when you have to pay, you are paying from the cash, not from the profit. So investors will be concerned with cash flow also. And profit maximization only shows profit, nothing to do with cash. So that's also not a good. So this three things tells you why profit maximization is not a good objective. Next, we are going to the criticisms of EPS. Most of the criticisms of EPS are similar to profit maximization, so you will not have an issue here. Number one, measure of profitability. See, earnings per share growth is measure of profitability. It is not wealth max generation or wealth maximization. Therefore, since it is also profitability, it's same criticisms as profit maximization. The previous slide, you can see all the three: cash, risk, long term versus short term. So all these three will apply for EPS growth also. So nothing more for me to explain here. Next, the disadvantage of EPS. What is it? Does not represent income of the shareholder. Because the EPS what you are calculating is what based on some accounting ratios only, some formula you're using. We have a formula for earnings per share. So that formula, how do you know it's an objective formula? Right? So it just represents the investor share of income based on some accounting formula, which is biased, which could be biased. So again, it's a disadvantage. It does not show the actual income of the shareholder. And next, finally, we are concluding this with the difference between maximizing and satisficing. You have to know the importance, the difference between these two terms. You must have seen the shareholder are maximizing their return, so satisficing their return. What is the meaning? Maximizing, the word itself says maximizing, right? Seeking them, I have underlined it in bold. The keywords are maximum level of returns. So to get that maximum level, what they will do? They will take more risk. That means they are now more exposure they will have to risk. And because of that, higher management workload, you have to work more harder now. Because nothing comes free of cost. If you want more returns, maximum return, you have to work maximum. Right? Satisfying on the other hand is what? It's like you're satisfied. Finding a merely adequate income. You're not finding maximum. An adequate outcome, which is good enough, satisfying. You're satisfied with it. Right? Satisfactory level. Not maximum level, satisfactory level. Avoiding risky ventures. You're not taking as much risk as when you're maximizing. Right? And reducing workloads. You're not taking so much of workloads. You're happy with whatever income you have. That is known as satisficing. So that's it with this video is over. Next, what video we have, the upcoming video, the most interesting. I really enjoy teaching this part. Right, this is heavily you will have in your SBL. Stakeholder objectives and conflicts. Who are your stakeholders? How do you identify stakeholders? What are the types of stakeholders? How do they conflict? How do you manage the conflict? Everything we are going to study here in next video. So that's it. See you in my next video.